This is Robert Kraft, and I am your host on the Planet MicroCap podcast. And with me today, my guest, coming all the way from Sydney, Australia, Mr. Tony Hansen. He is the Chief Investment Officer at Egp Capital. Tony, welcome to the Planet MicroCap podcast.
Thanks for having me.
It's great to have you on. So, I have to ask, what brings you up to the U.S.? I mean, you're fully Americanized already in your Texas Longhorns jacket. You're ready to rock.
Yeah, well, it's a combination of I haven't taken a holiday for a couple of years, so I'm sort of tying in a little bit of holiday making with a handful of company visits and seeing some potential investors and a variety of other stuff. So it's sort of 30% work, 70% leisure.
Well, you told me offline that you actually were at the Charlie Munger talk yesterday. I mean, I got to ask, how was that? Tell us a little about it.
It's excellent. I've been told that it's a more intimate version of the Berkshire meeting, or maybe like the Berkshire meeting was 20 years ago, and I found that to be much the case. I was saying to someone afterwards yesterday that Charlie's probably a little bit more concise than Warren, so in a shorter meeting he gets through quite a lot of questions, because Warren probably rambles a little bit more or sort of is a little bit more detailed, whereas if Charlie gets a question he doesn't want to answer, he's just pretty abrupt. So he got through a lot of material yesterday, and it was a really good experience. And
you were saying at 96 he's sharp as ever, huh?
Yeah, very, very sharp. As I said to you offline, I shuddered to think what he would have been like as a young man. His brain must have been frightening to watch in action.
Can you imagine 35-year-old Munger today? I mean, who knows?
Exactly, yeah. Well, he always says that how his life worked out was a lot of luck, but I think that 35-year-old Munger would have been just as successful today as what he was in the 60 years ago in the 1950s.
That's for sure. So, as you said, you're based in Sydney. I recently just had Matt Joss on the program as well, and I asked him about the fires down there. I mean, did it affect you? How's everything going? I heard there's a little bit more rain, so it's starting to kind of turn.
Well, it's the flooding started the day we left. Australia is a land of great variation, so droughts and flooding rains, and so we had droughts, fires and rains all in the last 12 months. At the moment, the floods are more of a problem than the fires, so that's just the nature of our country, unfortunately.
Extreme weather, extreme animals.
Yeah, there's a lot of extreme stuff down there.
That's for sure. So, again, thank you for joining us today. Like I said, I imagine that your original thought process was to, you were coming here just to be on the podcast, but, I digress. And, I really want to dig in now to your background and really what makes you to where you got today, So to start off, what is your background? How'd you get to where you're at today?
Well, I've got a highly uncommon resume for a fund manager. So straight out of school, I deferred my university studies and took over a family business that was sort of struggling a little bit. Turned that around and went through a variety of career changes along the way. So I sort of sold that business to a company from the west coast of Australia that was looking to break into the east coast. I worked for them for a little while. That sort of didn't work out, didn't suit me. Then I got into a variety of other things. I worked I worked in immigration, so I'm a big guy, as you've probably noticed. So I used to take drug dealers back to their country of origin, and I worked in immigration, doing that. So, and then through that time, I started working in the Department of Juvenile Justice, and I worked as a bouncer and a variety of other sort of jobs that relied more on physicality than intellectual skills. And along the way, I got into my mid-20s and thought, this is just crazy. You've probably got a brain that's a little bit more capable than this, and you shouldn't be using the brawn. And obviously, your physical skills will diminish over time, whereas your mental skills, if you keep them sharp, can probably work for a lot longer. So I went back and did my degree, became an accountant, a CPA. Started working in infrastructure accounting. So I worked in for large, no companies that your American audience will have heard of, but companies like John Holland, United Group, worked for Sydney Water, and our major grid companies like Endeavour Energy, so working in that sort of environment. Along that way, I because of my background in business, and I was always interested in investing, and so along the way I was building a small portfolio and sort of paying off my house and doing those things that young people do. And I really became more and more passionate through time about investing. And then through the GFC, that's when things really twigged for me, because I'd paid off my house by that time, and the Lehman Brothers bankruptcy hit in September of 2008, and so I had an unencumbered house, and I said to my wife, this is a once in a lifetime, potentially once or twice in a lifetime opportunity. Can we take a line of credit against the house and allow me to invest? And so that's what we did. It was only small, a $300,000 line of credit against my home, and fortunately the Australian banks at the time were very reluctant to lend, so it took them about 9 weeks to actually provide me the money, and all the while the market was cratering and getting cheaper and cheaper, and I didn't actually have the cash to deploy. So by the time I actually got the cash, it was I'm thinking it was probably late November, and it took me I was tapped out on that line of credit, save for a $10,000 limit that I left. So I'd used $290,000 out of that $300,000 line of credit by I think it was the 7th or 8th of February 2009. And then the market bottomed almost exactly 1 month later, and 2009 was a year that set my family up financially, because some of those decisions turned out to be pretty good decisions.
I mean, I have to ask. I mean, I have a couple follow-ups here. It seems like, well, firstly, what really got you hooked on investing? You mentioned that, you had a number of brawny type jobs, which I think we'll save that for another podcast. I'm sure there's some great stories there.
There are lots of stories there. I was very good at that job, but it doesn't pay as well. So your earning capacity caps out pretty low, and I earned more than most bouncers because, as I say, I was very good at it. But your earning capacity certainly tops out very quickly in that profession.
For sure. So what was it that got you hooked on investing while you're going through all these different odd jobs and even studying for the CPA?
Yeah, so I always loved numbers, which is why I always intended to be an accountant. Interestingly, through high school, it sort of always made sense to me. And numbers I always found easy. I was successful at maths in school. I immediately stepped into a failing business at 18 years of age, and so running business sort of was ingrained in me. It was a family business, so I was involved in it between the ages of 12 and 18 too. Business was ingrained in me, and I often say, you talk about all of those, I could go through, there's a number of, the career path is more interesting than the brief framing that I gave it there, but that's a huge part of why I've been a successful investor in my view, is because I come at investments from a different viewpoint than most investors. A lot of the traditional path to funds management, at least in Australia, I assume it's pretty much the same here, is that you go to high school, go to a good university, interning at an investment bank or at a broker or someone in the investment industry, junior analyst, senior analyst, portfolio manager. It's pretty much the same pathway for everyone. And so, not to criticise my peers, but a lot of those guys have pretty much the same worldview and see things the same way. Whereas I've run a failing business. I've worked in a variety of different industries. I've worked in a number of everything from as I say, in immigration to the hotel industry to juvenile justice, and I've just got a much more broad background that I think really gives me a different way to come at problems.
So I have to ask, I mean, because you took a massive risk. I mean, taking out a loan against your house in, just one of the craziest times in stock market. What gave you the confidence to take out that line of credit? I mean, how long had you been even investing for where you built up that confidence to say, you know what, I feel pretty good about making this bet right now?
I mean,
it's a high risk, high reward.
we probably had $200,000 invested in the stock market at that stage. So I was more than doubling my exposure, certainly, or maybe not quite 200, maybe 100. I was certainly more than doubling my exposure at the time, and I'd been investing for more than 10 years at that time, or about 10 years. So I had built what I. In hindsight, that question is probably more relevant in hindsight than it was at the time. I don't think I was nearly as good an investor as I thought I was 10 years ago. Investment, I always say, is one of the best industries in the world, because if you're passionate about it and you stick at it, you just get better and better through time. And almost any investor would look back 10 years and say, and think that they were not nearly as well-rounded an investor 10 years ago as what they are now. And I certainly do feel the same. It was probably more of a risk in hindsight than it felt like at the time. But it just felt like a generational opportunity, something that I was only likely to see 1 or 2 times in my lifetime, and that it had to be grasped. And, as much as we got there was a lot of luck involved. There's a lot of luck in almost anyone who has some success. The luckiest part about it was how long it took the bank to actually approve the loan, because I would have been deploying that capital much earlier. And the timing and the success that we had in 2009 was largely a factor of that 8 or 9 week period where I didn't have access to the capital. It would have cost me 15% probably of the return that I earned in 2009 if we'd got the capital, if the bank had come to the party real quick. So what gave me the confidence? I'm not sure exactly. It just felt that's an instinct part of it. It just felt like it was a once in a lifetime opportunity, and it had to be taken by the bull had to be taken by the horns.
Gotcha. And what was the strategy? I mean, was it compound on companies that you already had in your portfolio, or was it to deploy capital on some other opportunities that you saw?
Well, there was a lot of buying and selling. It was that type of market where you were buying something at 4 times earnings, selling something at 6 times earnings to buy something. It was really, when you look at the pricing in the market today, some of the opportunities that came along in 2009 to investors who are maybe cut their teeth in the last 10 years, they wouldn't believe how good those opportunities were. I bought some things through the GFC that I probably wouldn't customarily own. So we own some miners, for example, which I've only ever owned 2 mining stocks, I think, in the 10-year history of my fund. We bought a few through that time because some miners were being priced like commodities would never be used again. Like, it was a real Armageddon feeling. I don't know how well you might remember it, but Australia is a heavily commodity-focused market,
Yep.
and there was a lot of really good. You were buying miners for less than the cash that they had in the bank, and so the investing that I did then was actually quite different to what I usually do, to be fair.
So I want to also follow up on your background a little bit more, and because this is, I think, will lead us to what your investing approach and philosophy is today. What would you say are some of the lessons that you took away from those first few jobs? Taking over a family business, and obviously going to work and the brawny businesses. What were some of those lessons that really helped you in your philosophy?
Well, I mean, I've always been very thrifty. My grandmother, who died 2 years ago, well, she was 92, so she went okay. But she was the biggest influence on me, because as a young man, or as a kid, she would tell me stories about the Great Depression, and she was born in the 1920s and sort of living through that, and then the Second World War, and then she was from England, moved to Australia, and so her stories of thrift and so on had a real impact on me. And a penny saved is a penny earned, and all of those sort of sayings that you hear, and that thriftiness that she sort of talked about, that was a necessity for her, somehow burned its way into me. And so I wasn't earning big money as a young man. A lot of those jobs and industries I worked in, I wasn't earning large salaries, but I was always very good at saving and keeping my costs low. And that's a big part of the ethos of my current business, and so that's where a lot of that comes from. I think about rather than, there are 2 sides to becoming wealthy. One is to drive your earnings up, and the other one is to drive your cost of living down. And so I was always very, very good at that side of it. And over time, the investing helps to drive the other side of it.
Gotcha. So then let's catch us up to starting Egp Capital. So 2009 was a life-changing year. So then what inspired you to then start a fund a couple years later?
Well, I had 16 friends and family, as it happened at the time, that wanted help with investing, and anyone who's the investing guy in their family gets inquiries about what looks good, what should I be buying, and it got to the point where I couldn't really help 16 people individually sort of manage their finances, and I looked around at the managed funds that were available and decided that I didn't much like the way that they were structured. Most of them had high performance fees. 1.5% or 2% was common back at that time. It's starting to come down now. And then they would take, if they would take that 1.5% guaranteed, and then if they happened to outperform, they'd clip another big chunk out of the outperformance as well. And it just seemed like a really riskless business to me, and it didn't seem very well aligned. And I couldn't find anything that I thought that if I wasn't a self-directed investor, that I would want to invest in myself. And I'm not going to encourage my friends and family to do something that I wouldn't do myself. So I said to them, what about if I created a vehicle? Over time, my wife and I will liquidate our assets and bring them into that fund. It took about 3 years for me to do that. We started off with 400,000 of capital originally and 5,000 from 16 other partners. So that $480,000 capital in early in 2010, it was in 2010 was the start of that. So we're 10 years we've been going now. And from that time, it built over the course of 4 or 5 years. I started writing a blog because a number of those original investors didn't have any grounding in investing, and so I wrote a blog every Friday night. I would publish a blog that sort of talked about what we were doing and why. Mm-hmm. And over time, that blog developed a following, and then other people asked me to manage some of their money, and the fund grew from that $480,000 to about $15 million over the course of 5 or 6 years. And then I became associated with, or someone through Mark Tobin, who I think you know, introduced me to a fellow named Chris Cuff, who used to be the CEO of Colonial First State, which was the largest fund manager in Australia. He's retired from that job now, but he runs a number of charitable portfolios. And so Mark introduced me to him. I asked him if I could manage some money, and I rebate even the performance fee, so he was getting management fee free plus the rebated performance fee, and I asked him if I could do that for him, and then that way I knew he'd be getting my newsletters every month and he'd be aware of me. After a couple of years of doing that, I pestered him constantly saying, my fund, obviously we're doing pretty well and we should be managing more money than we are, and eventually he introduced me to, he's a bit better connected than I am in the industry, and that's where our fund grew from 15 to 50 million more or less overnight when he sort of started telling his associates about the fund.
Wow. By the way, we got to give Mark a little credit here. He actually, the whole reason we even were able to organize this is he recommended we connect on Twitter. So thank you, Mark, and thank you, Twitter. Full disclosure, I'm not a shareholder. But I also have to ask, before we get into philosophy and your criteria, I mean, did you ever imagine that investing and running a fund would end up being your full-time job?
I always hoped that it would. When I started the fund, it was always with a view to it turning into what it did. But when I was tossing drunks out of pubs in say 2005 or something like that, 2004. It didn't really occur to me at that point in time. When I established EGP, I did have a view that, and it was probably a lot of hubris at the time to think that, but that if I could be as successful as I thought I could, I always sort of hoped that if I could compound capital at 15% per annum, that I could double everyone's money every 5 years, and over time that would become, even with a small starting base, that over time we could build a real business, and then I guess the speed it feels slow now. The speed at which we got to where my fund is closed now, so this is not an advertisement opportunity. I've closed my fund at $90 million just because I think that's a level of capital where I can still stay in the MicroCap end of the market, which I enjoy, and earn the type of returns that I can earn without sort of slowing down the rate of return. Mm-hmm. I guess I always thought that we could get there, but the way that it worked is probably surprising in hindsight.
So did you always stay in small microcaps? Was that kind of the asset class that you always looked at as, high risk, high reward, this is where I can really build the wealth that I'm looking to build? Well,
my fund's mandate is actually very broad, so I can buy anything from the largest to the smallest stock. We can actually go international as well. So we are primarily Australian focused, and part of the reason why I've kept, I think much longer term than most investors. So I'm sort of thinking about 20 or 30 years time, and I'm thinking about if I compound the assets that we've got at the rate that I think that I can. I'm thinking about how large that pool of assets will be in 10 or 20 years time. So with a view to that, I kept the mandate of my fund very open, so I didn't want to restrict myself on size. Although I enjoy the microcap end of the market, I didn't want to completely restrict myself to that. And although I find the Australian market satisfies most of my opportunities at the moment, I didn't want to stop myself from going abroad as the pool of assets got bigger. So our mandate is very broad. Anyone who has read my monthly newsletter will know we also bought a very small. We bought 12% of an unlisted business. So we do some unusual stuff as well. So it's not pure listed. I really run my fund. I always say to my investors, like a family office. It's like I run the fund exactly the way I would if it was only my money in the fund, with a little bit of consideration for the fact that I've got about 80-some million of external assets. So I do have to think about liquidity. But broadly, I try and do what I would do if it was just my money in the fund.
Gotcha. So, now we're getting to the investment approach question, but I wanted to preface it that, the fund has really done very well since inception in 2011, using the ASX 200 total return index as your benchmark. Egp Capital has grown 350.4% versus the 209.5% according to your website. So here we go. Let's get it. What is your investing approach, and how have you been able to be so successful?
So mostly I would describe myself as a small cap value investor or a microcap value investor. I look for, and value investing is one of those things that a lot of people get, have different ideas about what that is. To a lot of people that means buying a low PE. I don't think that that's the case. As Charlie Munger said at the DJ Co meeting yesterday, value investing is buying something for less than what it's worth, and it doesn't necessarily have to be a low price compared to the broader market. If you're buying something that's going to grow faster than the broader market, you can pay a slightly higher price than the market, or you can pay the market price for that, and it's still a value investment. So, but broadly, I would consider, I always break the portfolio into three buckets. I have what I would consider to be a traditional value investing, which is low-priced earnings type businesses that are, that are likely to grow at faster than their multiple implies. And I say I break it into three buckets. There's no guarantee that 1/3 of the portfolios in each of these three buckets at any point in time. It's a lot to do with opportunity set. I have a bucket of what I would call high quality businesses, which we don't own a lot of at the moment because of the price of high quality businesses, but occasionally you'll get the opportunity to buy a very good business at a price that doesn't, so it may be an above market multiple, but that business is such a good business that I'm happy to buy that. And then in the third bucket is things, special situations, I guess you would call it, where you might have a hidden asset on the balance sheet, or something that's not obvious that requires some work, and we can be, I wouldn't describe us as an activist investor because I don't like to do that too often, but we can be, part of the reason we like to play in the small end of the market is because I will often, to the extent that I can, help our management to execute on a plan. I've got a reasonable network now, so I can help to introduce potential investors and partners, and if I find an asset that I think's undervalued on the balance sheet, I'll often try and realise that value.
Mm-hmm. So you mentioned earlier in the interview, and you also say this on your site, is that your typical holding period for a lot of the stocks in your portfolio is an average of 10 years. Was this a conscious decision, or is this more that these are the companies that you're looking for, hence I want to hold it for that long, as opposed to something else?
Well, mostly, Charlie Munger calls it sit on your ass investing, and I very much am a fan of that. So if you can find a really good company that's at a fair price and it never gets to the point where it's above the intrinsic valuation, the stock price is trading at above that, I'm very happy to hold a good business like that. Part of the way that we get that that long holding period, so it's called the Concentrated Value Fund, my fund, and so our top 15 investments probably have on average 75% of our funds invested in, and we have this long tail, and that's where most of the actual portfolio turnover happens. So actually in our top, I should say as well, I should preface that by saying when I talk about portfolio turnover, I'm only talking about the things that I've consciously sold. So we actually do turn over more. We've turned over about 25% of our portfolio this year through a number of large holdings getting taken over. When I talk about turnover, I'm talking about the things that I decide to sell out of the portfolio. So that's the weighted. We've averaged over the last 10 years 12.5% per annum of our portfolio gets sold consciously on market. So I'm not talking about takeovers. I exclude those because that wasn't something that was out of my control. So yeah, we actually average an 8 or 9 year holding period, and our largest investment has been my largest investment since I discovered it in 2008 in the GFC, and it's been our largest investment ever since. And I've never sold a single share of that stock. So yeah, that's been our largest investment for 12 years, and I fully expect it to be in the portfolio in 10 years' time.
Got it. So then what's some of the criteria that you look for in a potential new investment?
Uh, a lot of people say that I'm focused on the technology sector, or I look at utilities or whatever the case may be. I'm a generalist. I'll go anywhere. All I'm looking for in any situation is that I can be persuaded that I'm buying more than I'm paying for. If I'm it's the old saying of getting a dollar for buying a dollar for 50 cents. As I said about the three buckets earlier, that the way that discount comes could be different in nature, but all I'm looking for is that I feel like I'm getting more than I'm paying for. I'm 100% focused on buying something for less than what it's worth, and mostly my tendency is to avoid paying very high multiples. So I'm not a growth investor in that way. We rarely own really growthy businesses. Purely because it's much harder if you buy something at 50 or 60 or 80 times earnings. You have to be very certain about the future growth profile of that business. Or if you buy something that's not actually making any earnings yet, that's sort of might be making revenue but isn't yet profitable. Those businesses are very, very hard to model a future, and so anything that we do own ends up in the tail of the portfolio. Whereas the vast majority of what we own very large positions in the top 15 sort of positions, they tend to be cash flow businesses. I'm looking for something that really spits out nice regular cash. Often the Australian market pays a very high dividend. Our portfolio probably has a slightly above market dividend, which is unusual in the microcap sector. So we look for companies that will return capital to us as well.
So then on your investing process side, tell me a little bit how you go about, let's say you find something that you're interested in. What's then the process of going in and starting to build a position in that company?
Well, that's changed over time. Obviously, we're managing a lot more money now than we were 5 or 10 years ago, certainly a lot more than 10 years ago, and quite a bit more than 5 years ago. So now, if I'm buying something that I think is going to be a top 15 or 20 holding, and often we're buying smallish microcap stocks, one of the things, when it comes time to buy, and I've already done the research at this point, if I can't put my foot on a 1% position via a block trade or some sort of, a lot of these stocks are very hard to buy on market, so one of the first things that you want to do is actually put your foot on the business, and then we'll start to accumulate after market. But the process, I would say on average, we've probably followed a company for at least 2 years before we buy. I'm very slow moving. Actually, a lot of the CEOs and so on of the businesses that I talk to, they find it quite frustrating because they can see that we understand their business and that we can appreciate the value in their business. But part of that's that 8-year holding period is in order to be able to hold for that long, you have to be very certain on the way in about the decisions you're making, and part of that is just taking a long time and making sure that you're right before you make that commitment. So, and that's, I would say we probably know most of the companies that we end up buying for a couple of years before we actually commit. So I'm a long courting process.
I was going to say, especially if you're playing the small microcap arena, management is so key, So, for you, what do you tend to look for then in management to make sure that, okay, I think they're a good steward of capital, good capital allocator?
It varies from business to business depending on the type of business. In our top 10 portfolio holdings, I would suggest that the average founder and insider and director management holdings in that group would probably exceed 50%. Mm-hmm. So it's not uncommon, and in a lot of microcaps you will get this. You have large founder managers. But a secondary criteria to that, and part of the reason why we tend to move pretty slowly, is you want to see how that management behaves. If you become a minority shareholder in a majority-owned situation, and then they don't behave well, as much as the business might be good, they might pay themselves too much. It could be bonuses, equity issuances, and these sorts of things that dilute the return that sticks to the ribs of the investor. So I spend a lot of time thinking about, it's all well and good for there to be a big insider ownership, but you want to see how those people behave, and as long as their behaviour is good over time, that could be paying dividends, not paying themselves too much, and a variety of those type of things. But that's a real common feature of our larger holdings.
So I as I said earlier, we had Matt Joss on a couple days ago, and one question I asked him that I'd love to get your opinion on as well is, what would you say is some of the big structural differences or just differences in general between looking at Australian small microcap ecosystem versus North American microcap ecosystem?
I would say the biggest difference, I haven't seen Matt's interview, so I don't know if he's going to agree with this, but the biggest difference is that probably 70% of our smaller microcaps tend to be exploration mining companies, so which sort of makes the Australian market much easier in many ways, because really there are about 2,300 companies listed in Australia, and if you're not going to look at the exploration and mining space, you can probably rip 1,700 out of that 2,200, so you're down to sort of 500 companies. If you're going to take out anything that's the biggest companies, and if you're going to look at microcaps, you're probably going to pull another 100 out of that at least, so there might be 300 or 400 realistically that you narrow your universe down to, which I think that's the one advantage you've got in the US market. It's an advantage and a disadvantage, I suppose, because you end up with this huge universe of potential stocks to look at. So in some ways it makes it simpler. But so really it's a smaller market, and Australia has a pretty good technology sector. We've had a few successes. Technology is a good business because if something succeeds globally, it doesn't really matter where it's domiciled. If it's a good tech business, then it can succeed anywhere. So,
gotcha.
Yeah.
So as a follow-up to your investing philosophy and your approach, starting off as a self-directed investor, having a great year, 2009, starting the fund then in 2011. Now you have about 90 million assets under management. How would you say your investing approach has changed from that self-directed kind of doing your own thing to now, you have all these assets under management?
Well, it certainly does make it harder to move around in the market when especially at the end that I play in. So a lot of our median market cap in our portfolio is about 85 or 88 million. I tend to like to put at least 2% of our fund to work in any idea, and our larger holdings have 10% of the fund in them. So putting $8 or $9 million to work in a microcap can be very hard. So some of our larger holdings are actually a bit bigger than that, but so. The biggest difference is how hard it is to move around. So you need to develop relationships with brokers that when you're I would say this to your retail investor group, they don't realise what a huge advantage they have of being able to move in and out in a small way. It's a much bigger advantage than you realise it is. I didn't think about it that much in 2000 and in the early 2000s when I was you can sort of you can own a $10,000 or $20,000 or $30,000 position, be in and out in a heartbeat, and that is everyone says that institutions have better information and certain advantages, access to management, but I think that it's more than outweighed for a good retail investor is the ability to move around unimpeded by size. That's the biggest I guess change in the business.
Mm-hmm. It actually kind of ties in. I would assume, because my next question is going to be, what would you find to be the most difficult part of your job? And I'm already going to chalk that answer right in there as well to that too.
I think it is. One of the other things. My fund is a retail fund, so because we started with friends and family, it's unusual. A lot of funds, decent sized funds, tend to be focused at institutional and what's in Australia called the wholesale investor, so larger investors. So we've got 350 investors, I think, or 330 investors it might be in my fund. So we actually have quite a big investor base as a consequence of the way that my fund was built. So I probably, for the average $90 million fund, I probably have more contact with a broader investor base. Not that that's a difficulty. It's we have a lot of very smart self-directed investors inside my fund, and because I'm a one-man operation effectively, I actually get a lot of inbound ideas from my investor group, which is very useful. I probably get an idea or two a week, and like most inbound ideas, 80% of them very quickly go into the too hard basket. But occasionally I can mine that vein for value.
Nice. So as a quick follow-up to and you mentioned this earlier in the fund construction, but I wanted to kind of harp on this because I think it's an interesting difference between your fund and maybe some other funds that are out there, is that you don't take a management fee. It's just performance based.
Yeah, I have some some unusual opinions in this regard, and I was saying this to someone yesterday. I'm not as dogmatic as I used to be about this idea. There are investors out there who are talented enough that they are worth paying a fee to. I used to believe that all the way through my career, I would always structure my base salary as low as possible and my bonuses as high as possible. I've always been someone who backs himself, and so it's always been my inclination to do that. And I've always thought that the nature of fund management is that having management fees encourages the wrong behaviour in the fund manager, is that they're trying to grow their pool of assets. They'll tend to grow their pool of assets larger than potentially their strategy might warrant, because if you're getting a 1 or a 1.5 or a 2% fee, the larger that pool of assets is, the bigger your guaranteed income is. But if you depending on what you're doing strategy-wise, if your asset base gets large enough, you actually will impede your ability to earn an appropriate return. So, my own thrifty nature is a big driver of why I think the zero management fee is philosophically right. Mm-hmm. But the other part is that it aligns what the investor wants with what the fund manager wants, and so I've restricted the size of my fund relatively small, not because if I doubled my assets over the next year, I could probably earn just the same level of return as what I do now. I don't think it'd seriously impede me, but I'm thinking 5 or 10 years out about compounding, and I want to make sure that this fund is my personal track record as an investor, and it matters to me to have a good track record, and any money that I might earn out of it is sort of a side effect. And that's one of the things that I think that fund management should trend towards, is that people who manage money actually shouldn't really need the money that they earn out of it. They should be doing it because they're passionate about business and fund management. Any fees that come out of it should be more of a side effect than a primary driver.
Amen. So I also really wanted to follow up on another thing you said earlier when it came to the Australian markets, and how you're, and I'm not saying you do this specifically, but that you're, especially if you cut out all the junior minors, and and you're really looking at more or less, I think you said 500 names, something like that. Yeah. So for you, because you have so much access to you have a big network and you get new ideas kind of thrown at you every day. I mean, has this also not forced you, but caused you maybe to also look abroad to North America and other parts of the world for companies to bring into the portfolio?
We have of late bought our first North American stock. So as I said, our fund is unconstrained in its mandate, so right. I can go anywhere and do almost anything within certain limits. So obviously I have to put some framework around that. Right. I don't think that, to be fair, I don't think our current size, even if we doubled or tripled our funds, we wouldn't need to go abroad. Australia there's about a $2.4 trillion equity market there. I'm running $90 million. It's if I can't find $90 million worth of ideas in Australia, I'm probably not trying hard enough. But it is nice just to have that option there, because you just never know what's going to happen. Occasionally individual markets go into their own manias, and if that happens and there gets to be a situation where there's nothing really attractive to buy and I've got cash, then I don't want to be constrained. So that's why I've left open international markets, and I'm sure at some stage, once the pool of assets gets to a certain size, we'll be quite active internationally, I should imagine.
Gotcha. So this is my favorite question to ask everybody that I have come on here. So what would you say is an investing experience that really impacted you the most in your career? We already talked about on the good side, so perhaps maybe there was one failed investment that you're like, oh, I learned a lot from that one. I put a lot of time and effort into this, and dang.
It's happened a couple of times to me, almost always in commodity businesses, is that you learn about you think about risks. There was an investment that I had. It was one of the rare mining investment. It was in the fund actually, so it was certainly, I'm just trying to think when it was, maybe in about 2013. We owned a business called Mount Gibson Iron Ore, which has an asset called Koolan Island off the coast of Western Australia. One of the richest iron ore deposits in the world. It sits, but it's on an island, and so it's got its own port, its own access. It's mining some of the richest, highest iron around, and it's shipping it a few metres away at their port. So it's just a beautiful asset, really good cash flow. I remember sitting and explaining to one of my closest investor colleagues who runs a little fund. There's the only thing that can go wrong with this, because they've mined so deeply into the body of the island. There's a seawall that protects the mine from flooding. I remember saying to him, the only thing that can really go wrong with this, you were paying at the time around the cash holdings of the company. They were earning really quite impressive earnings. It was trading at a low earnings multiple. One thing that can go wrong is if they have a hurricane or a cyclone, as we have, and the seawall breaks and the mine floods. It's just there's this one piece of tail risk. And that happened probably about 6 weeks after I explained it. It was a relatively small position, and this is why whenever I take a commodity, and a more recent version of that, in what I didn't consider to be the same type of risk, is that we own a timber plantation asset that's on Kangaroo Island, and 95% of that has been fire affected in the recent bushfires that we've had in Australia. So that, these are, you sit and everything that you do as an investor is about weighing probabilities. There's a 30% chance of this, the 30%, you sit and weigh it all out, and then you put a price on the outcome if that happens, and a price on the outcome if that happens, and so you weigh these probabilities. And I remember thinking this when in recent situations like in Brexit and when Trump got elected, there was a 92% chance that Hillary Clinton was going to be your president, I think, from most. And so people say, well, these people are idiots, they got it wrong. But there was an 8% chance that didn't happen, and that happened. And so occasionally those 5 or 8 or 10 or 20% chances, they happen. They happen. That's how probability works. And so when you talk about tail risks, occasionally you do get the tail happens, and it's happened a couple of times to us. And you just got to remember about position sizing in that situation where that tail risk has a real cost to it, just to make sure that you're sized correctly.
I was going to say, so how do you then think about it in terms of, so let's say you're looking at a potential investment. Let's say it even has that high probability of being good business, succeeding, growing, compounding over time, but there's that 5% risk factor. How do you go about then that, either the position sizing or really, I guess it's just building that position when you have that 5% risk? Like, what's the catalyst that then gets you over the hump where you start to see that probability, that 5% go down?
Well, it's not that the 5% doesn't go down. It's just that what's the outcome if that happens? And in both situations, well, we're not 100% certain about the Kangaroo plantation situation, but in the Mount Gibson iron ore situation, there was a big insurance payout. They rebuilt the seawall, and if I'd have held that investment, I actually sold it because the thesis was broken. So that's the thing that you do when you've got a thesis and you say if this works out, then this is how we'll go, and if it doesn't work out, then the thesis. I actually would have been better off holding that business as it happened. Iron ore has performed very, very well. Subsequently, they got a large insurance payout. There was a LNG project not too far away, so in the interim they were getting income because they were being used as a landing site for and so a relatively decent management team ended up making a pretty good fist of that situation. They repaired the seawall and the mine's active again. In the case of Kangaroo plantations, they've got a substantial insurance payment that will be coming to them. The majority of the market cap will come back as cash because their timber asset has largely been burned. So the insurer is going to. So basically, you're bringing forward a lot of that cash flow. Unfortunately, because probably the timber value was underinsured because they didn't yet have a port asset. They were in the process of applying for a port, so the timber value is probably slightly underinsured. But it's just a matter of working out if that 5% event happens. Is it a complete loss of value, or will some value be realisable? And in both situations that I just described there, it's as I say, the second one's harder to tell because it's happening in real time now. But in the first one, you actually didn't end up with a terrible investment outcome. You would have earned probably less than the markets returned over time, but the actual investment outcome didn't end up too bad. So it's about saying what is the risk if that happens. And the short-term risk was that the stock price of Mount Gibson Iron Ore got hammered. Mm-hmm. But the longer-term risk of a good management who took that insurance payout and did all the right things, they found other ways of earning income using the island as a landing and so on, that a good management can actually make a fist out of that. So it's really about deciding what the downside is in that situation. Is it a complete loss of capital, or can some value be realised?
Gotcha. And just to be clear, so you sold out of the iron ore position, but you're still a holder in the Kangaroo Island timber?
I don't have an option, to be fair, because it's suspended at the moment. The stock's suspended while they sort of assess what's going on.
So what advice would you have then for new investors that are looking to deploy capital in the stock market?
Well, my realistic advice is that if you're passionate about learning about investing, there's no better application of your time than learning to become a good investor. So, but don't. A lot of, and I probably did this myself, a lot of investors when they first start are probably making decisions when they don't really know what they're doing. So my real advice would be to have someone manage your money for you while you learn. So if you want to invest in the stock market but you know nothing about it, not to invest all of your money initially until you actually learn a little bit about what you're doing. Maybe have some money professionally managed, or buy an index fund, or do whatever strategy you might decide for that. But if you really take the time to learn how to be an investor, and if you have an aptitude for it, you can do very, very well. The stock market has a tailwind. The Australian and American markets have both averaged a high single digit, or maybe as much as 10% over a reasonably long run. The power of that sort of level of compounding is amazing. People don't think about that, but at 10%, your money doubles every 7 and a bit years. You think about that. If I've got $100,000 worth of assets now, it becomes $200,000 in 7 years, 400, 800, accepting taxes, of course. But that's the rough idea of that. That has a real effect over time. If you can beat the market by 5% and get 15%, all of a sudden your doubling comes down to 5 years. And the power of that over time, I don't think is well enough explained in schools, certainly in Australia. I don't think, if people learned and understood that, I think everyone would want to become an investor, because it's just magic, the power of compounding, according to me. So, but the thing I would say is that to make sure that you spend the time to actually know what you're doing, because so many retail investors get caught up in the next hot stock. It's might be whatever it is. It could be the tech boom when it happened, or the pot stock boom when that happened recently, or whatever. Might be the lithium. There was a big lithium boom in Australia. I'm not sure if you imagine you guys had some lithium stocks here that probably went nuts a few years ago when this extremely commonplace commodity that no one happened to be mining enough of at the time, and people got excited about the value of it. But then as soon as, it's not actually all that hard to find lithium, so a few mines opened up and all of a sudden there's a huge supply available of it. And it's just to think rationally about these things. Whenever you see a mania about a given idea, as I say, it might be the tech boom in the 2000s and late 1990s, or pot stocks, lithium, whatever it is, just to remember, someone will make a lot of money in those. Bitcoin is a good example, of a boom that had no real basis in any sort of fundamental. Is to just try and sit back and look at that as an unpassionate observer, and sort of think about, does this make sense? Think about. I always think that one of the biggest advantages I've got as an investor is that I think 5 and 10 and 15 years out, and so you can withstand more volatility if you think that way. But just knowing what you're doing is something that I would say to retail investors. You just must think about, do I really know what I'm doing when I invest? It was something that someone said to me on Twitter the other day when I commented about some advice that I gave a relative of mine. They were talking about buying this stock, and said someone on a forum says it's 80 cents, it could be $3. Well, that's not a basis on which to make an informed investment decision. Why will it be $3? If you think about that, if you can actually model out the probabilities of that, And so you want to know what people will spend more time thinking about buying a $1,000 fridge than they will putting $10,000 or $20,000 of their capital to work in a business, and it's insanity.
Mm-hmm. So with that, where can my audience go and find more information about you and EGP Capital?
Oh, you can go to my website is egpcapital.com.au, and you can sign up for my monthly newsletter there if you're into that sort of thing. If you want to find out about, I usually write a pretty comprehensive explanation or thesis about one of our stocks at least every couple of months. And for your North American, which I imagine most of your audience is, I think we'll be writing about, if not this month, then certainly next month, about our one North American holding. So it may be of interest to your listeners.
And Tony, real quick for full disclosure, do you own any shares in Kangaroo Island, which you had mentioned, or DJCo?
No, I don't own the Daily Journal company. I was there as a visitor. We do own, and it's disclosed in my monthly newsletter as about our fifth largest holding, Kangaroo Plantations. We do own. As I said, I can't sell it anyway if I wanted to at the moment because it's suspended. So, but we do own that, and yeah.
And where to next? Are we going to Disneyland later today, or is that tomorrow?
I'm not going to Disneyland. My travelling companions went to Universal yesterday. I'm going to Santa Monica Pier for lunch after this. So, yeah.
Well, you picked a great time to be here. The weather's perfect.
It is good.
And with that, Tony, thank you so much for joining me on the Planet MicroCap podcast. And I look forward to our next chat. It'll probably be over Skype.
Possibly. Thanks for having me.
Thank you.
All right. Nice. Cheers.